Nobody knew his name. Nobody tracked him. He secretly controlled $100 billion without a single regulator knowing. Until 2 days in March 2021. Monday morning, March 2021, one stock begins to fall. Goldman Sachs makes a call. Morgan Stanley makes a call. Credit Suisse makes a call in 48 hours. $20 billion gone, and the man responsible. Nobody had ever heard of this as Archegos Capital. Nobody knew his name on Wall Street, where everyone knows everyone. Nobody talked about him. Nobody tracked him. Nobody monitored him. He had already been caught once in 2012. His previous fund, Tiger Asia, had pleaded guilty to insider trading. He had paid a $100 million fine. He had been banned from managing public money in Hong Kong and the United States, and yet by 2021, he secretly controlled positions worth over $100 billion in stocks in companies, in markets without a single regulator knowing until 2 days in March 2021, when everything collapsed and he lost $20 billion and almost took the entire financial system with him. This is Bill Hwang and this is Archegos Capital Management, the invisible empire that nearly broke Wall Street. Bill Hwang was born in South Korea. In 1964, he came to America as a young man. He worked his way into finance. He joined Julian Robertson's legendary hedge fund, Tiger Management. He was brilliant, disciplined, ruthlessly focused. In 2001, he started his own fund, Tiger Asia. Tiger Asia made extraordinary returns. Hwang became one of the most respected emerging markets traders in the world then. In 2012, the U.S. Department of Justice came knocking. Asia. Bill Hwang's fund had been trading on insider information, getting tips from investment bankers about upcoming stock offerings and trading ahead of them. Tiger Asia pleaded guilty. Hwang paid a $100 million fine. He was banned from managing public hedge funds in Hong Kong and the United States. Most people facing those consequences would have stopped. Bill Hwang did not stop. He found a loophole. A family office manages money for a single wealthy individual or family. It is not required to register with the SEC in the same way as a public hedge fund. It does not have to disclose its positions publicly. Its activities are largely invisible to regulators. Bill Hwang created Archegos Capital Management, registered as a family office, and began quietly rebuilding, but this time he used a financial instrument that made his positions even more invisible. Total return swaps. Here is how total return swaps work. Instead of buying stocks directly, which would require public disclosure, Hwang made private agreements with banks. The banks would buy the stocks on his behalf. Hwang would pay fees. The banks would pass him the returns. As if he had owned the stocks directly, the stocks appeared on the bank's books, not his. His actual exposure was completely hidden. He was not required to disclose either, was not regulated on it, and he used enormous leverage. For every $1 of his own money, he was controlling $5, $6, sometimes $7 market exposure. By early 2021, through this invisible mechanism, Bill Hwang controlled positions worth over $100 billion in a handful of stocks: Viacom, CB's, Discovery, Baidu, GSX, Tech, Advenomous. Concentrated positions from everyone, including the very banks that had helped him build them, because each bank only saw its own piece. Goldman Sachs knew its own swap exposure. Credit Suisse knew its own swap exposure. Nomura, Morgan Stanley, Deutsche Bank, Wells Fargo, UBS, none of them knew how exposed Hwang was to the exact same stocks through all the other banks simultaneously. This was the invisible time bomb ticking at the center of Wall Street. Then in March 2021, Viacom CB's announced a stock offering. New shares would be sold to raise capital. The price began to fall, as it often does when new shares are created. Hwang's positions began losing value. The banks began issuing margin calls, demands for Hwang to post more collateral Hwang could not meet. Then what happened next was the financial equivalent of someone shouting fire in a packed theater. Simultaneously, in every row at the exact same moment, Goldman Sachs began selling Hwang's positions to recover its money, but because so many other banks shelled the same stocks through Hwang, when Goldman started selling, the stocks fell further, which triggered margin calls at Morgan Stanley, which caused Morgan Stanley to sell, which drove prices down further, which triggered margin calls at Credit Suisse, which caused Credit Suisse to sell in 2 days. The most violent forced liquidation in stock market history. $20 billion in personal wealth wiped out Credit Suisse, which had given Hwang the most generous leverage terms. Lost $5.5 billion in a single week. Nomura lost almost $3 billion total. Losses across all the banks, over $10 billion in 2 days. And the extraordinary thing was that almost nobody outside Wall Street had heard of Bill Hwang. There were no television cameras outside his office. There were no newspaper headlines warning ordinary investors. The largest margin call event in history happened almost entirely in silence. Then slowly, the scale of it became clear. The Wall Street Journal published the story. The financial world was stunned, not just by the losses, but by how it had been possible. How had one man banned from public markets accumulated $100 billion in secret positions that almost no regulator knew about? The answer was the system allowed it. Family offices were specifically designated operate below the regulatory threshold. Total return swaps were specifically designated keep positions off public records. The banks, who should have been sharing information about their collective exposure, were instead competing to give Hwang more leverage than the next bank because the fees were extraordinary and the risk they each assumed was someone else's problem. Bill Hwang was arrested in April 2022. He was charged with racketeering, securities fraud, and wire fraud. Prosecutors alleged he had conspired with his chief financial officer to manipulate the prices of stocks in which Archegos held massive positions, creating artificial demand to keep prices high while the positions were being built. In July 2024, after a trial that gripped Wall Street, Bill Hwang was convicted on 11 of 12 counts. In November 2024, he was sentenced to 18 years in federal prison. He was 60 years old. His chief risk officer, Patrick Halligan, was also convicted and sentenced to 3 years. The banks that had enabled Hwang, despite knowing his history of insider trading, paid regulatory fines and continued operating. Credit Suisse, already weakened by Archegos, faced additional scandals in the years that followed. Dan was eventually acquired by UBS in 2023 in an emergency rescue delivered by the Swiss government. One man's invisible gamble contributed to the death of a 167-year-old bank. So what is the real lesson of Archegos? Archegos was not possible because Bill Hwang was uniquely brilliant. It was possible because the system was specifically designated to allow Itaman banned from managing public money, simply moved into a structure the regulators could not see. Banks competed to give him leverage without asking what other banks were also doing because the fees were too good to walk away from. Regulators had no visibility into what a family office was doing because family offices were specifically designated to be invisible. The lessons of 2008, that hidden leverage and concentrated risk can bring down the entire system, were forgotten within a decade. Archegos was not a surprise to those who understood how the system worked. It was inevitable. The only question was when, and the answer was the moment one stock started falling in one morning in March 2021. That is the capital case. The most dangerous risks are not the ones everyone is watching. They are the ones hiding in the structure, specially designed to avoid scrutiny. Subscribe to the capital case because the next case is already waiting.